Hello everyone, welcome to this video. In this video I'd like to talk to you about how to make quality investments in stocks and how you can set up a diversified investment portfolio. Why? Well, first of all, just like anybody, you don't want to go bankrupt, but you also may want to make an investment altogether that's sustainable, especially if you are thinking about investing in the mid to long run. And in doing this, you also may want to earn a decent return for longer than just today or tomorrow. So if all of this would have been easy, of course, everybody would have done it. And every stock market investor would have been rich and happy. Sadly, however, this is not the case. So if you want to invest in stocks, you need to learn how to do so properly. And here our first problem starts: how to select a stock to invest in. And the problems don't end here either. I would argue that designing a proper stock portfolio is at least as important as selecting individual stocks to invest in. Again, especially for people who are seeking investments in the mid to long run. But then the question is how to design a proper diversified stock portfolio, and should you add other investments aside from stocks also to this investment portfolio. So without any further ado, let's jump into this topic. So a quality investment in the stock market starts, of course, with quality stocks. A stock represents the company behind it. It's a piece of ownership of a company. Hence, finding quality stock means that you have to find quality companies. So the companies behind these stocks, if these companies are proper, if these companies are decent, and if these companies have potential, then the shares, of course, also will. So the process of understanding the value of a company is called valuation. This process is not only about the today of the company, rather it's also about this company's yesterday and tomorrow. Did the company do things in the past that are shady, or did the company do things that are proper? And what situation is the company currently in? And if you look at the tomorrow, what is this company's future potential? So in terms of a company's past, you may want to look at different things when you are evaluating a company. You may want to look at its past achievements and whether they are still relevant for today's investment choice. You may want to look at its mistakes and how it actually dealt with these mistakes. And you may also want to look at whether this company in the past has kept its word when it made promises, for example, regarding when it said it was going to invest in something, right? And so whether you can actually trust on this. In terms of a company's today, you also may want to look at different things. You may want to look at its income and its expenditure and the balance between that. You may want to look at the company's debt compared to the company's equity, and so whether this equity is sufficient in the worst case scenario paying off this debt. You also may want to look at the quality of this company's management, the quality of this company's board of directors. You also may want to look at this company's assets, equipment, facilities, and where this company actually is located and whether that's a risky place or not. And other stuff that may matter also for this company's economic viability, such as possible lawsuits, such as scandals it's associated with, and so on. In terms of this company's tomorrow, you may want to look at the company's strategic plans. You may want to look at this company's research and development budget and its other investments, and through this understand whether this company is only thinking about its today or is actually also investing in further improving its competitive position for tomorrow. You may also want to look at this company's trade agreements and whether these are promising also for the future. You may want to look at the quality of those investors investing in this company, because that's of course an important signal of quality. You may also want to look at the quality of the partners of this company, how many rivals the company has or may have in the future, for example, new entrants to the industry, and of course how all of the competitors in the industry are developing, whether they are developing faster than the company you want to invest in or slower, and so on. Of course, one thing that's also very important here is the risks that the industry is facing in terms of how attractive its profitability position is, and whether this position will remain, whether this position will improve, or whether this position will deteriorate. So think about the risks that the oil industry is facing, because the sustainable energy, of course, sector industry is currently really making an upward move, and so of course threatening the dominance of the oil industry as one of the most important source of energy. But you can also think of the risks of the traditional automotive industry now that the electric vehicle sector again is quite alive nowadays and seemingly going to replace the traditional automotive industry anytime soon. So the second thing that you need to look at for a stock, aside from the valuation of the company behind it, is the pricing of the stock itself. So is the stock cheap or is the stock expensive? So is the price of the stock high or low compared to the company's valuation? Of course, what you want is that the stock, in terms of its price, is cheaper than you thought the company should be worth. Because if that's the case, that means that you can invest in the stock and the stock can increase in value to the level that you think the company should be worth it. And all of that difference is going to be profits to you when you're selling the stock. So in this regard, you may, for example, want to look at the company's P to E ratio, which is basically a ratio that tells you how high the stock's price is compared to the company's earnings. So if the company's earnings fall short in accommodating this company's stock price, then this might indicate towards a bubble. So too high P to E ratio indicates a stock market bubble. This means that the stock is overvalued and most likely there's going to be this stock price correction. This basically means that the stock price is very likely to face a very sharp downfall rather than an increase, and this means that it's very likely that you're going to make big losses on this stock. So important is to compare the P to E ratios within a sector. So you don't want to be comparing, for example, the P to E ratio of the automotive industry to, for example, the technology industry, because every industry has different norms for profitability and different norms for stock prices. So different dynamics across sectors mean that P to E ratios need to be compared within sector. So you also may want to look at whether the company that you are thinking of investing in gives dividend. And so the question, of course, here then becomes, does the company share with you its profits? As, of course, the dividends are a piece of the pie, the company's profits, a part of it that it gives to its shareholders is what we call dividend. And if you are eligible to part of this dividend, this of course makes the stock more interesting, because you're not just going to benefit from a stock price increase, no, you're also going to benefit from all of the future income streams of this company. So once you've compared the valuation of the company with the price of its shares, with whatever. So if you're going to look at, are my company's share prices cheap or expensive compared to the company's value that's behind it? So what type of an image unfolds? And of course, in doing this, you don't only look at the companies today, you look at its past, you look at its future incomes, future revenues, you all discount them to the value of today, and based on that, you're going to make the decision of whether your company's value is high or low compared to the stock price, and only if the image that unfolds when you're comparing, if that tells you that the stock price is lower than the company's valuation, only then it means that you could potentially invest in this stock. This does not mean that you should invest, because you don't know other companies. This exercise that we have done just tells us the story for one company. And for one company, it's going to mean that this company's potential is not yet priced in, and that this company's price is attractive, and that you may think of investing in this company's stocks. But it does not mean that at that point you should be buying and that you should spend all of your money on this company's shares, because you should compare this company and its shares with other companies' shares. Multiple companies at the same point in time will have shares that are cheap. And of course, if you're just going to buy one company's shares, or if you're just going to buy one share perhaps, you want to buy the one that is the cheapest. This is what we of course call opportunity costs. So we have been mainly talking about buying a single share, but the quality stock market investment often consists of quality stock portfolio, one that is ideally diversified. So what does this mean, and why do we need such a portfolio? Well, it is very risky to put all of your money in just one stock. You don't know what the future is going to bring. You don't know what the global market is going to do, the global economy, the global political situation. The same thing counts for the national situation, for the regional situation. You don't know sectoral risks as well. So all of these risks, global, national, regional, sectoral risks, all of these at some point, if you are unlucky, can center around your stock, and this can cause to you huge losses. For example, if you look at what happened to the aviation industry, they faced global shocks, national shocks, regional shocks, sectoral shocks, all because of the pandemic. And sometimes this happens, but at the same time, the e-retail industry, e-retail sector did not face these shocks. And if you had a diversified portfolio where you had, for example, aviation stocks and e-commerce stocks, then the upside, the gains that e-commerce stocks were going to face would compensate your losses and the aviation stocks that you had invested in. So you should build a diversified stock portfolio to protect yourself from massive losses through spreading your risks and to protecting yourself from the unexpected. A stock market portfolio should, of course, consist of quality stocks. So you are not going to build a portfolio of whatever stocks. No, the portfolio should only embed stocks that are of quality, and these stocks will help you not only to spread risks but also grow your investment in a quality manner, but also with that in a more diversified manner. The stock market portfolio should first of all embed different geographies to protect yourself from geographical risks. If you just have the stocks of, for example, companies in whatever country, and if in that company there are going to be massive strikes, or if there's going to be earthquake, then you're going to be in the middle of all of these risks. So you want to diversify also in terms of geography first, to make sure that you're not, with all of your money, are going to be in the middle of all of this. An important other metric, important other thing that you want to look at for diversifying your portfolio is looking at the beta. So the beta, or how you want to pronounce it, of your stocks, B-E-T-A. So the beta, basically what it shows you is how your stocks are correlated with the stock market trend. You can actually, whatever stock you have in mind, just Google the name and then say stock price on Google, and often there it will already show you the beta to you. And so beta shows you how your stock is correlated to the stock market trend. Basically meaning that if the stock market goes up on average altogether, what's going to happen to your stock on average over the course of, let's say, the last year. A positive beta basically means that your stock is positively correlated to the stock market. This means that on a day that the stock market goes up, most likely your stock's price is also going to go up. A negative beta means there's a negative correlation. When the stock market tends to go up, your stock tends to go down in terms of its stock price, and vice versa. Also, the number is important here. It's not just whether it's positive or negative, but also how close the beta is to 1 or minus 1. Because a beta of 1 or minus 1 means that your stock is kind of identical to the general average stock market movement. And the farther your stock is your stock's beta is away from the stock market in terms of the beta. This means that, for example, if the stock market goes up, your stock might go up 3 or 4 times faster. Or if the stock market goes up, that your stock is going to increase much slower in the same direction. So all of this information is important, and all of this information the beta is going to give you. So what the beta basically gives you in more theoretical terms is that it tells you whether you can protect yourself from these general stock market shocks and risks. And so if you have a diversified beta stocks in your stock market portfolio, this means that your stock market portfolio is protected from general stock market risk. So finally, you may want to have a portfolio of different types of companies, ideally companies that are more or less risky. So some firms are bigger, others are smaller. Some are older, others are younger. Some have proven themselves, others have yet to prove them. And of course, this is going to play into how the stock is going to behave. If a company is bigger, older, and has already proven itself, it means that this company's stocks will grow less hard, but will also fall much slower. And so these companies, the stocks, are going to give stability to your portfolio. Other firms that are smaller, younger, and have yet to prove themselves, they may grow much faster, but may also go easier bankrupt. And this is also something to keep in mind. Also, something that you may want to consider are, for example, penny stocks. Penny stocks are stocks that on the eye look quite cheap. So the company behind it can be very big, the company's valuation can be very sizable and large, but the stock itself might be relatively cheap. You might get one stock for 50 cents, $1, $2, whatever. Psychologically, people are more tempted to buy these stocks than a stock that by itself is quite expensive, because there's a big threshold towards buying the first stock. For example, if one stock is worth $500 and the other one is just worth $1, then if you have $1,000 to invest, you can only buy 2 shares that are each worth $500, but you're able to buy 1,000 shares of $1 each. So in the end, of course, you have a total investment of $1,000, so you might say, who cares? But now think about it. Imagine that you have $499 to invest, and this one stock is worth $500. You cannot get any of it, but you can spend all of this money on this stock that was worth only $1. You can actually buy 499 of it. And a lot of people don't want to spend too much money at the same time on the stock market, because there are a lot of small investors, and these investors will go for these penny stocks. And so psychologically, so you will see a bigger swing in these stocks than in stocks that have a bigger price. Finally, we may also want to make a distinction between growth stocks and the non-growth stocks. Growth stocks are basically what kind of resembles the stocks we talked about in terms of being smaller, or stocks that yet have to prove themselves. But oftentimes in this category we also find tech stocks, platform stocks, digital stocks, stocks of companies that have a massive potential in them that have yet to be realized, but investors trust on these companies to really be something amazing in the future and are investing in this. And you will see that these companies have a very high upside. They really can grow very, very fast, but they also have the risk of collapsing rather swiftly, because a big part of the valuation of these companies is expectation and potential rather than what they have already shown in the past. And a big clear example in this regard can be the comparison of, for example, a company like Tesla, which does not have that much profits yet, but has a massive valuation and a massive stock price. And you can compare this, for example, to Toyota or to Ford or whatever. Toyota and Ford and similar automotive companies have shown and proven themselves so much more than Tesla, but people expect so much from Tesla because it's an electric vehicle producer, and because it very much so invests in the sustainability trend, that people expect great things from it, and not so much, at this point at least, from these giants from the general traditional classical automotive sector. And here you see the difference between a growth stock and a more traditional type of a stock. So having said all of this, consider expanding your investment portfolio beyond just stocks, right? So stocks are relatively risky. A company can collapse, it can go bankrupt, and there are many other types of assets that you can put in your portfolio that are so much more stable. These will grant you a lower return because they are less risky, but they will also give you more stability and security, something that you may seek and look out for, especially if you are a smaller investor. So you may even want to have some assets in your portfolio that are inversely related to other of your assets. This is actually called hedging. So think about stocks and gold. Oftentimes when the stock market goes up, and because people are using their money to invest in stocks, gold will go down in terms of price because people are selling their gold to make those investments. And so here you see an inverse relationship where when the one goes up, the other goes down. So if you have both in your portfolio, then the nice thing of this is that you can protect yourself from whatever risk, because at some point at least one of the two will go up. And if you have a good diversification here, to make sure that at any point in time you're never really going to be hit massively, you will always at least have something that's going to rise, and you can always sell something when it is kind of peaked. You can sell that and then put it in something that's at that point at a low point of its development cycle, and then you can wait again for that to go up, and with that money again buy something else that is at its dip. So in general, diversified general investment portfolio not only consists of stocks, but also consists of gold or silver or other precious metals or raw materials. It also tends to consist of bonds, real estate, energy investments can be part of it, like oil, like gas, like biofuel, or whatever comes to your mind. Just make sure that you diversify to not face a situation that you would rather not be into. And don't forget, investment in the stock market or any type of an investment is rather risky. So never invest without doing your homework. If you lose money that you cannot miss because you have initially invested money that you should not be investing, because that much money you cannot miss, only yourself are to blame for. I hope you enjoyed the video. If so, please don't forget to hit the like and the subscribe buttons. I wish you all the best in the world and hope to see you again anytime soon. Take care.